How much cash should you really keep as an investor? Is it 0% because cash is trash? Is it 50% because the market might crash tomorrow? Or is there a smarter way to think about it? If you're a beginner investor, this question is way more important than it sounds. Holding too little cash can force you to sell investments at the worst possible time. Holding too much cash can quietly destroy your long-term wealth thanks to inflation. So in this video, we're breaking down why cash matters, the 3 types of cash every investor should think about, how much beginners should realistically hold, and common mistakes to avoid. Let's simplify this once and for all. What do we mean by cash? First, what is cash? We're talking about money in your checking account, savings accounts, high-yield savings accounts, money market accounts, not stocks, not bonds, not crypto, just liquid, safe money that won't fluctuate in value tomorrow. Cash has 3 major characteristics. It's stable. It's liquid. It loses value over time due to inflation. That last point is critical. When inflation rises, like we saw after 2020, cash loses purchasing power every year. That's why many investors quote people like Warren Buffett saying, "Cash is a terrible long-term asset." But here's the thing. Cash isn't meant to be a long-term growth asset. It's meant to protect you. The 3 types of cash investors need. Most beginners think about cash as one bucket. But smart investors think in 3 buckets. Emergency fund. This is non-negotiable. Your emergency fund should cover job loss, medical expenses, car repairs, major unexpected bills. For most beginners, that's 3 to 6 months of essential expenses. If your monthly expenses are $3,000, you should aim for $9,000 to $18,000 in safe, accessible cash. This money is not for investing. It is insurance for your life. Short-term goal cash. Are you buying a house in 2 years? Planning a wedding? Starting a business? If you need the money within 1 to 3 years, it probably shouldn't be in stocks. Why? Because markets are volatile. Look at history. During the COVID-19 market crash, markets dropped over 30% in weeks. During the Great Recession, it took years to fully recover. If your down payment is invested and the market drops 25% right before you need it, that's devastating. Short-term money equals cash or very safe instruments. Opportunity cash. This is where investing strategy comes in. Opportunity cash is dry powder, money ready to deploy when markets drop. Some investors always keep 5 to 10% of their portfolio in cash to take advantage of corrections. For example, if the market drops 20%, having some cash allows you to buy quality assets at a discount instead of just watching from the sidelines. But here's the important part. You don't need a huge pile of opportunity cash. Trying to perfectly time the market rarely works. Even professionals struggle with this. How much cash should beginners hold? Let's make this practical. For beginner investors, here's a simple framework. Step 1. Fully fund your emergency savings. 3 to 6 months of expenses in cash. If your income is unstable, freelancer, commission-based job, lean closer to 6 months or even 9. Step 2. Set aside short-term goal money. Anything needed in under 3 years stays safe. Step 3. Invest the rest. Once those 2 buckets are covered, long-term money, 5+ years, should generally be invested. For most young long-term investors, that means emergency fund, maybe 10 to 20% of total net worth early on. Very small additional cash buffer. The rest invested in diversified assets. Many passive investors who follow strategies inspired by people like Jack Bogle prefer staying fully invested according to their asset allocation rather than holding large cash positions. And historically, markets trend upward over long periods. For example, the S&P 500 has averaged roughly 8 to 10% annually over long stretches, but only if you stay invested. Common cash mistakes. Let's talk about beginner mistakes. Mistake 1. Investing without an emergency fund. This is the fastest way to panic sell. Mistake 2. Holding too much cash out of fear. Some beginners sit on 50% cash because they're waiting for the crash. Mistake 3. Confusing comfort with strategy. Cash feels safe. But long-term, too much cash is risky because inflation quietly erodes it. A simple rule of thumb. Here's a beginner-friendly rule. 3 to 6 months emergency fund. Cash for short-term goals. 0 to 10% extra cash for flexibility. Invest the rest for long-term growth. As your portfolio grows, your percentage in cash will naturally shrink relative to invested assets, and that's usually a good sign. Cash isn't good or bad. It's a tool. Too little, and you're fragile. Too much, and you're stagnant. The goal isn't maximizing comfort. It's building resilience while letting your money grow. And remember, smart investing isn't about predicting the future. It's about being prepared for it.